This debt ceiling crisis just being postponed. We're seeing the impact on the stock market. How will this play out in the forex market? And I'm just wondering how much risks is being priced in.
Hi, morning, Haslinda, Yvonne. Thanks for having me. Now, I think for the U.S. debt ceiling's impact on the FX market, arguably on a historical observation perspective, it doesn't really have any impact beyond short-term repercussions. And I think the main transmission mechanism into the FX market is that when you get a risk sentiment wobble in the equity market, whenever we come very close to the 11th hour, what you get in the FX market is that you might actually see some liquidations of currencies that are well shorted. For example, the Japanese yen, the Swiss franc, or even the Australian dollar that are very well shorted and have extremely large short positions in the market. Those can actually get a little bit short covered when you get a risk sentiment wobble in the financial markets in general.
The debt ceiling, of course, one issue impacting markets, the other high energy prices. We know that high energy prices supporting the likes of the CAD, the ruble. How much has been priced in already?
Yeah, I think that is definitely where we think over the next 3 months into the winter season, we would rather be owning the CAD, the ruble, the Norwegian kroner, and also perhaps the ringgit into winter. I think the Canadian dollar looks interesting given the fact that there has been a lot of a profit taking, and now when we look at the market positioning, which is showing that the market is still net short the CAD. So the CAD might actually have a bit of room to catch up with the higher oil prices. So that is something interesting as well. The Australian dollar, not forgetting a large exporter of coal and natural gas, that is also a beneficiary in the next 3 months.
Teck Leng, I was going to ask you with just the debt saga, the debt ceiling saga in the U.S., it seems like the typical type of response you get is that the market's going to go and turn to Treasuries as almost like a haven bid, which almost seems counterintuitive given the fact that that is where the very pressure and where the risk is right now. Is that still the case this time around, given that we have these inflation concerns in the market?
Yeah, exactly. So I would fully expect that to play out as well. So long-term Treasuries remaining the safe haven. So even if there is a specter of a ratings downgrade, I think the reality is that the US 10-year yield move might actually be downwards. So that is still the case. And just looking at some of the sensitive currencies to US 10-year yields, I think we are looking at the dollar yen that is the best proxy to play a risk off. Given that if US 10-year yields were to go down by 10 basis points, it could actually translate into a 1 yen per move sensitivity. So from that angle, the dollar yen downside protection might actually be an attractive option.
And Teck Leng, yeah, you take a look at the renminbi against the peers, it's still looking almost like it's a Teflon currency. But if you take a look at the premium that Chinese 10-year bonds have with Treasuries, for example, right now, and that premium is slowly just narrowing right now. We're at 133 basis points. Is now the time just to short the renminbi?
Yeah, I think to us it is almost surprising that the Chinese yuan hasn't really reacted much to the negative news flow around the Chinese property sector and also the incoming weakness of the Chinese economic data. So I think just from a fundamental perspective, the Chinese yuan is looking a tad too strong given the economic dynamics and the divergence between the Fed and the PBOC, which is on the dovish side. So I do think that if anything, we have a weakening bias for the Chinese yuan. We have a target of about 660 over 6 months. So I would say that for the dollar CNY, it is definitely biased towards the upside, especially as we head into the year-end taper by the Fed.
Yeah, and it kind of goes with your report on the shifting tides in favor of the dollar right now. And I have to wonder, I mean, we're still seeing negative real rates in many countries right now. How likely are negative real rates going to drive FX the next months to come?
Yeah, so I think for that reason, if you look at which economies have negative real rates, it is still the Eurozone and in Switzerland. Japan is almost at zero. So I think precisely for that reason, these are really the central banks that are lagging behind the global monetary tightening cycle. Vis-a-vis, for example, the Fed, the Bank of England, Norges Bank, for example. So I think within FX, the yield differential and the dynamics of the yield differential over the next 6 months would actually favor central banks that are more hawkish to the likes of the Fed, the Bank of England, the Bank of Canada, versus the currencies that we are bearish over the 6 months period, which is the euro, the Swiss franc, and Japanese yen for the same argument.
Teck, you talk about how you have a negative bias for the yuan going forward. I'm just wondering, how will that play out for Asian currencies? Lots of headwinds for them going forward, including a slowdown in China's growth.
Yes, exactly. So for the Chinese yuan and its impact on the broader Asian currency complex, the Chinese yuan definitely is seen as an anchor currency. So the fact that most, if not all, Asian economies have China as their major trading partner means that they would be at least reluctant to see too much currency appreciation against the Chinese yuan. So when we have a 2 to 3% downside over 12 months for the Chinese yuan, it would cut across most Asian currencies. I would probably highlight that there might be a few Asian currencies that might be a bit more resilient. For example, Singapore dollar, it is in a different monetary policy cycle where MAS is still hawkish and by tighten policy, the Sing might actually be holding up better on a relative basis within Asian currencies itself.